Foreign currency exchange can have a big impact on your business if you're doing business overseas and moving money back and forth between countries. It has an impact on the revenue you receive and the profit that you generate. So I want to talk about an example. Let's assume you're a US-based company and you have operations in France. You're operating retail locations in France. And every month, the French business, the French subsidiary, sends 50,000 euros to the US. So every month, the profits that are generated from the French organization gets transferred to the US. Let's talk about how that happens from a foreign exchange standpoint. So let's assume the exchange rate in March is $1.2 for every 1 euro, 1.2 to 1. So that means when 50,000 euros are sent to the US, we multiply 50,000 times 1.2, so we're getting $60,000. So $50,000 euros becomes $60,000 US dollars. Okay, that's March. Let's talk about April. Let's assume that the exchange rate changes. Now you only get $0.98 for every euro. What that means is that the dollar has weakened. You get fewer euros for every dollar. So now when the 50,000 euros get sent to the US, you only get $49,000. First transaction in March, you got $60,000. Dollar weakens, you only get $49,000. And they're sending the same amount of euros, 50,000. That stays the same. Final one, let's say in May, the dollar strengthens. You now get more dollars for every euro. They send 50,000 euros over. It's a 1.3 to 1 ratio. You get $65,000 for the 50,000 euros. So what's happening in this example is each time we're sending 50,000 euros, but because of exchange rate changes, the dollars that you receive are changing each time. So this is a big problem for business, and one of the solutions is to create a hedge where you pay a fee to lock in the exchange rate at a future time. So maybe you want to pay a fee so that 3 months out, you, the US company, are getting a 1.2 to 1 exchange rate. Why? Because that creates predictability. And you're paying a fee to get rid of the unpredictability and the volatility in the exchange rate. So this is a way that companies handle foreign currency by hedging.